Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The neckline of the August to November 2021 complex triple top, currently at 24.42, was and still is part of what I suspected 13 weeks ago to be part of a new pattern. It is the November 2023 to date descending scallop pattern. The neckline plus the congestion between 23.90 to 24.08, containing a July 2012 high at 2400 and the 50% Fibonacci line of the combined March to November and November to December 2023 moves, all these together provided overhead resistances. Now, going back to the descending scallop pattern idea, this backward letter J pattern finished its run upwards as the target on the upside for the run upwards in the 24.05 area and started its second decline since late January. The steady decline from late January to changeover last week had, for the most part, run along down the underside of the purple highlighted upper tine, and that's currently at 22.58 of the early November 2023 to mid-January 2024 bearish shift pitchfork. 2 weeks ago, there had been a strong drive higher over the upper tine, but failed at the overhead congestion between 23.90 to 24.08, containing that important 24.05 area. And by the end of that week, prices had turned lower. We then had the changeover, and we've gapped lower, well into the stratified congestion zones between 2140 to 2148, 21 even to 2107, 2069 to 2076, 2047 and 2003, where we have seemingly gotten stuck. I would note the role the bright red highlighted April 2020 to date uptrend has played in seemingly securing the downside, currently at 2069. So, we have left behind not just a descending scallop pattern, but a changeover gap moving lower, and also a weekly key reversal down 2 weeks ago on the continuous charts. Now, the market is not moving there right now, but should prices go all the way down to the low 20 evens, as they did back in late December last year, then I'll make some significant targets below. One secondary target which is currently off the bottom of my daily chart. It all now depends if the stratified congestion below will be strong enough to not just slow the market, which it has done already, but eventually halt the market and turn prices higher before it has a chance for a confirmed break below 20 even. So for the moment, watch the action between the bright red uptrend below and the purple upper tine overhead. Ice Europe, white sugar in London. The market has been wading down through stratified levels of support below and turning it into resistances now above. We have overhead a band of previously mentioned stratified supports that have now become mainly overhead resistances between 625.30 to 602.70 down to there. Just below, we have the breach but seemingly unbroken support of the purple coloured trend line, uptrend, currently at 602.60, dating from October 2022. There is further congestion below between 59.90 to 590 even, to 592.80 until the December 2023 lower 585.10. And then nothing much until the bright red middle tine, currently at 565.60, of November 2023 to January 2024 bearish shift pitchfork, as well as the February 2017 high at 565 even. When looking at what would be next, I said the following 5 weeks ago, and it's still valid, and I quote, "In the process of falling, hesitating, and then rising, the market created not just like in New York, like in New York sugar, a November 2023 to date descending scallop pattern. The question here is the same for London and New York sugar. What's next? Well, typically for such a descending scallop pattern, there are two pathways. You could expect a hesitation around this 670.90 area for a short while, before either a drop back down to the December low zone down in the 585 even zone, or you could see, after a hesitation, a fresh move higher, that will punch up through the November 2023 high at 772.90 area, 90. End of quote. Since then, prices had a changeover gap lower, which was part of a larger move lower. I said last week, and I quote, "We are realistically looking at a potential test down to December 2023 lows down in the 585 even zone." This prompted me to draw in bright red an early November 23, late January 2024 bearish shift pitchfork. And though prices have not slid along the underside of the upper tide, well, that's currently at 633.40 as they did in New York, the bearish shift pitchfork still shows the bearish angle of attack of this market, with prices in between the upper time above and the middle time below. End of quote. Right now, the market has become caught in the viscous congestion between 625.30 to 602.70, which I would now extend actually to 585.10 to 625.30. The breach and seemingly unbroken purple uptrend is now reinforcing that viscous congestion zone, whilst the bright red upper tide is coming lower each day to meet the market from above. Sugar white premium spread. It must be close to, if not over a year here, that this chart continues to be one of the busiest and most colourful of all my daily charts, weekly charts even, let me for that. Many things are still going on all at the same time. Okay, so I'd previously spoken some while ago now about two big picture items here, seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with prices currently testing the lower time below. That's currently at 130.25. Now, I've said this so many times before, and I'll keep repeating it here yet again. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle of attack of this market. In more recent activity, we have seen prices around and on occasion down through all the moving averages. Notably, the long moving average currently at 130.25, which is the lowest at the moment, and the medium moving average currently 139.75, which is currently the highest. We also have the two 50% Fibonacci lines at 128.75 and 131.5, as well as the June 2020 high at 134 even, for the market to deal with and try or not try to overcome. In the last 4 months or so, the market, despite some sterling efforts, has become somewhat trapped between the overhead congestion between 152.75 to 155 and the congestion below between 128.75 to 134.25. Further up, we have congestion between 162.75 and 164.75 and 173.75 to 175 even. Whilst below, well, we don't have that much below apart from the October 2023 low at 118.75. Now, the market could maintain itself sitting here between the nearby supports below and the resistances above, though it may have to make a decision soon as the dark blue lower time of the 2019 to 2021 bullish Andrews pitchfork pushes up over the 128.75 to 134.25 congestion support by the end of April. The question remains as to whether the market has enough ammunition to punch down through the congested support below and ultimately break the lower time and the long-term bullish Andrews pitchfork. I am still not sure on this point. You see, we've had lower prices in September and October last year, but eventually they turned higher, leaving an island pattern behind. And the lower time was then down in the 113 even area. Not where we are now, over the 130 even area. I will nevertheless be paying close attention to what happens at and near the lower time. Just remember this. It requires a minimum of 2 consecutive weekly closes below the lower time to even consider it being broken. And given this market, I imagine it might need a few more consecutive closes than that to confirm it. I would only point out one other thing. Below the dark blue lower time is another lower time, currently at 118.5, but this time it is from the non-highlighted August 2021 to September 2022 bullish shift pitchfork. Now that pitchfork might come into play if the highlighted blue one is properly broken.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.